So, namaste everyone, and welcome back to the lecture 8 of Fundamental Analysis of Companies. In the previous lectures, we have done profit and loss statement, we have done balance sheet, cash flow statements, and we have also done 3 lectures on financial ratios, part 1, part 2, part 3. And this is going to be our final lecture on financial ratios. And we will be covering inventory turnover ratio, asset turnover ratio, and your EV by EBITDA ratio in this lecture. And after covering these ratios, we'll be proceeding to next of our topics as listed. So let's proceed. Now let's start with our first ratio, which is inventory turnover ratio. So the word inventory means the cost of the goods which are currently in the stock, or the amount of goods which are currently in the stock. Let's take an example. Imagine yourself as a car showroom dealer and you have 10 cars in the stock and the worth of each car is 10 lakh rupees. So you have an inventory worth of 1 CR, or I can say that you have an inventory of 10 cars. Okay. Now the inventory turnover ratio is calculated as your cost of goods sold divided by your average inventory. The cost of goods sold is the cost which is involved in directly making that car. Okay, you can't really take the market price. Suppose you sell 8 of those cars at 12 lakh, you are not going to do 12 into 8 to get your cost of goods sold. That would be wrong. You would be doing the cost actually involved in making that car into the number of cars, which is 10, or number of cars, which is 8. Okay. The average inventory, how average inventory is calculated? It is basically the inventory at the start of the period. Say suppose at the starting of June you have 10 cars, and at the end of the period, suppose at end of June you are only left with 2 cars because you have sold 8 of the cars. So it would be 10 plus 2 divided by 2. So you would have an average inventory of 6 cars. Okay, and then you can easily calculate your inventory turnover ratio. Now the physical significance of this ratio is how many times are you able to sell your entire inventory. This will basically also signify that how fast is your company selling its inventory and generate revenue. So this is your physical significance. So that's why when you see a inventory turnover ratio of 5, that means that company over that particular period. Now the period can vary. It could be quarterly, it could be yearly, it could even be monthly. And in some of the cases, it could even be daily or say 21 days. So within that particular period, how many time is the company able to sell its inventory? The higher the better, but we'll get to it. Now the methods involved in calculating this financial ratio is, so you have Ind AS 2, which is your accounting method standard set by India, and they have like LIFO, last in first out, FIFO, first in first out. What this basically means is it depends on the company. Suppose you are a car dealer, it depends on you. You want to follow a LIFO method where the last car that gets into your stock, it gets out first, or it is the first car which gets into your stockyard gets out first. So you can follow your method, but you have to mention it in your annual report, which method you are following. Okay. Now the important point, the action point to remind here is that if your inventory turnover ratio is less than 1, that would basically means that your inventory is piling up, your sales are going slow and you are overstocking, and that is not a good sign. On the other hand, if your inventory turnover ratio is high, say it is greater than 3, that means you have better sales or you have better inventory management skills. Now you might have noticed there was a time when the car showrooms used to be very, very big. Have you noticed that they have shrinked? You might have also noticed that some of them are actually reducing their inventories so that they can accommodate a reduction in inventory, which will reduce their overall cost involved in the space, in renting, in air conditioning, in maintaining. So that's called inventory management. We have just in time method for inventory management and a lot of other methods. So how well a management is able to do inventory management is accounted for here. But if you have a very high inventory turnover ratio, I mean, you might be very happy, right? That this company is able to sell so much faster, but there could be issues. If a company has a very high inventory turnover ratio, it would basically mean that it has exponential sales, but it doesn't has inventory to sell it. Now, if you remember in the last year or during COVID, the automobile sector has the similar things. Just after the COVID, there was a waiting period on cars for 6 months, for 1 year. And because of that, the companies were losing customers because the customers don't want to wait for 1 year. They want the car like in 1 or 2 months. So they were going to their competitors or they were trying to buy another cars. So that's where if you have a very high inventory turnover ratio, it is a good news, but you might eventually lose your customer because you might not be able to fulfill their demands. Okay. So the action item here is that your inventory turnover ratio should be stable and it should at least be greater than 1. Okay. Now let's take our example. So as you can see, we are here comparing our Tata Chemicals with the peers. And what you can see here is that the inventory turnover ratio of Tata Chemicals is 2.6, while the peers, Deepak Nitrite had almost 8, Pidilite has almost 4. So this could mean that somewhere or other the Tata Chemical sales are a bit less, its inventory turnover ratio is a bit less, even it is less than the industrial median. So we'll be analyzing these, and we will also go to the past historical data of Tata Chemicals inventory turnover ratio in our hands-on session. So let's wait for that. Now the next ratio which we are going to study is our asset turnover ratio. Similar to inventory turnover ratio, the physical significance here would be how much value am I able to generate from the assets which I have. Now suppose you are the owner of a car washing machine. Okay, you have a machine which washes the car and you have one such machine. Now how much revenue can you generate just from one such machine is your asset turnover ratio. It basically tells you how efficiently the company is able to utilize its assets to generate the revenue. Okay, now in order to calculate it, you take your net sales divided by your average of total assets. And average of total assets again would be calculated similarly. Your assets at the starting of the period, your assets at the end of the period divided by the number of period. Okay, now let's take an example of the same Tata Chemicals and try to compare it with our peers. So you can see the asset turnover ratio of Tata Chemicals is 0.49. While the peers, some of them have greater than 1, 1.18 for Pidilite, or even for Deepak Nitrite it's 1.67, while the median is 1.15. Now the asset turnover ratio seems to be less, right? But wait, what factors could cause this thing? Now suppose if I involved a lot of money currently in buying new asset, so my asset at the end of the period would be higher, right? So my net assets would increase, but I have just bought those assets. Suppose you buy 10 more car washing machines, but you just bought those. You still have to make it operational, you still have to generate revenues from it, but then your overall asset turnover ratio would come down drastically because you invested heavily in buying machines which are yet not utilized fully. So you would be having a decrease in your asset turnover ratio. So that could be the reason. But the other reason could also be that the company is not able to utilize its assets well. And for that, we have to see the past data. If in the past, the companies have better asset turnover ratio, but just for this year, they are having a sudden decrease, that could mean they have added more assets. So in that case, you have to go to the financial statement and you have to check if the companies have increased their asset for that particular year. Okay. So now the last ratio which we are going to cover today is your EV by EBITDA. And EV means enterprise value. And EBITDA is a earning before interest, tax, depreciation, and amortization. Now you can go to the lecture 2 and try to understand what EBITDA was if you kind of forget it. Yeah. So let's calculate the EV by EBITDA ratio. So in order to calculate your enterprise value, you basically would have to add your market capitalization, which is your total number of outstanding shares into current market price. Here we are not taking the face value, here we are taking the market price which is currently out in the market. Okay. Plus you have to add your total debt, which are short-term borrowings or your long-term borrowings, and you have to subtract your cash and cash equivalent. Now here it becomes a bit tricky. You might be confused that the cash and cash equivalent belongs to the company, and why finding enterprise value, why are we subtracting it? Now, this is the benchmark formula which are being used like as an industrial standard. And the reason we subtract it is because we want to only account from the operational assets that we have. Now cash and cash equivalent can be labeled as a non-operational asset. And that's why we want to subtract it. But nevertheless, if you really want to find the actual enterprise value, you can add these, and then you can add the goodwill values and a lot of other things too. Okay. Now, when you divide this by your earning before interest, tax, depreciation, and amortization, the physical significance would come out. It would basically means how many years can you recoup, can you get your investment back if the company is at zero growth and if the share price is at zero increase. Okay. So that in at that particular moment and in these particular conditions, in how many years would you get back your net invested values? Let's try to understand this with the help of an example. So as you can see, the Tata Chemicals EV by EBITDA is around 7.65. So that means in 7.65 years, if my growth is 0% and my share price remains same, I would be able to get my investment back. Well, for Pidilite, it is 63.43 years. Now you might be wondering, is a high EV by EBITDA good or is a low EV by EBITDA good? And by now you might have understood it, right? If you're able to get whole of your investment back in fewer years, it's better. So if you compare with the industrial median, it's 11.35 years what it would take to get your investment back. So in general, if your EV by EBITDA is low and your company is fundamentally strong. Now remember, EV by EBITDA is not telling you if the company is fundamentally strong or not. Similar to the PB ratio, it never tells you. It only tells you if the stock is cheap enough to buy. Okay. And if the EV by EBITDA is say 2 times or 2.5 times of your industrial median, that means it's an expensive stock. It has a higher valuation. But if your EV by EBITDA is way higher, that could also mean that you are currently in a bubble. Your stocks price are too high right now and the enterprise value is not justifiable at this much high price. And then you can actually look around and see the growth and whatnot. Okay, so these are the things you have to keep into account. So the action point here would be to see if your EV by EBITDA is around industrial median or not. And if it is way low than that, that's a good thing considering the fundamentals of the company is strong. Then you found your value stock, you find a stock at a bargain. So as promised that we are going to create a single table with all the ratios with the peers and you can analyze it in a view. And here is your table. And don't worry, we'll be learning on how to create this table in the hands-on session, and it wouldn't take more than a minute to create all of these. And you can just look through these, you can look through your peers and you can look through all the columns which has all the ratios. There are a total of 15 ratios, and you can just compare quickly if how is the debt doing, is from book value, if the company is cheap enough or not, from say your interest coverage ratio, can the company cover its liabilities or not, from gross profit margin, whether the gross profit for this company is good as compared to peers or not, and all the things that we have learned till now. You can just look through the table, and in a single table you can analyze all these things. So let's go to our hands-on session. So let's go to screener.in and type our example, Tata Chemicals. And let's go down to the peer comparison and let's go here and edit our table. So in the table, the first thing we have to learn is we have to put is inventory turnover ratio, and it's here, and I think I've put it somewhere. Yeah, it's here. Let's put it here. And the second thing which we have to put is your asset turnover ratio, right? So your asset turnover ratio is here. Let us put it in the second column. And the third thing is your EV by EBITDA. Okay, EV by EBITDA. Yeah, let me just put it here. Okay, it might be with some other name. Yeah, it's your EV by EBITDA. So let's just put it here. And let's just save our columns. So you can see that the inventory turnover ratio, asset turnover, and EV by EBITDA pops up for Tata Chemicals along with its peers, and also the median at the bottom. So you can actually analyze like we learned right now. Now you might be wondering, like we have to do two things, right? One is to analyze it with the peers, and the second is to analyze with the historical data. So for the historical data, let's go to moneycontrol.com and let's type Tata Chemicals here. So just type Tata Chemicals on moneycontrol.com and scroll down to this financials page. And in the ratios, let's just click on the turnover ratios. And you can see that your inventory turnover ratio has actually reduced in the last 3 years. And the same goes for asset turnover ratio. Now you really have to go to your financial statement, annual financial statement, and try to figure out why this happened, because in March 2020 it was pretty high. The reason could be the sales have dropped. This is the first thing you have to check. And the second thing is, if the sales are still rising, then there could be there could be a change in the method of accounting for inventories, or there could be some other change which we really have to look through. Okay, so this is our asset turnover ratio and inventory turnover ratio for historical analysis. And if you go to your valuation, you can see here you have your EV by EBITDA. And since last 5 years, especially considering last 3 years, it has gone down, and that's a good sign for us to buy, because we are finding it at cheaper valuation. But you can't just go and buy it. Okay, what you have to look at why it went down is the share price. So you have two things in EV by EBITDA, right? First is enterprise value, but the share price in the last 3 years for Tata Chemicals has increased. So that means your numerator has increased. That would hint us that somewhere its earnings are increasing. Its EBITDA has increased significantly, that even though its share price has increased, it has still brought down the EV by EBITDA ratio. Okay, so that is a good sign. So this is how you have to analyze. Break it down into if the numerator has increased or if the denominator have increased. Okay. So that's all for the historical analysis of these three ratios. So now is the time to create our final table where we can put all the ratios together and analyze. So let's type here Tata Chemicals. I think you might have already figured out how to do it, but yes, for the sake of doing, we want to do it. So let's go to peer comparison, and I have deleted here almost all the columns. So let's go to edit columns and type them one by one. So the first ratio we learned was price to book value, right? Let's type here price to book value. Let's bring it here. Let's just remove this for now. The second one, yeah. Second ratio we learned was EPS. Okay. EPS. The third ratio we learned was PE ratio, price to earning ratio, and the fourth ratio we learned was PEG ratio. Okay. Now in the lecture 6, financial ratio part 2, we started to learn our current ratio. Then we learned our quick ratio. Then we learned our debt to equity ratio. Okay. And at last, what we have learned is your interest coverage ratio. Okay. So in the lecture 7 of financial ratio part 3, we have learned the profit ratio. So we have your gross profit margin. Then we have your operating profit margin. Let's take this for the last year. And then you have your net profit margin. Okay. After that, in this lecture, even in the last lecture, we have also learned ROCE, right? So return on capital employed. And then we have also learned your returns. So you have your return over 1 year and your return over 5 years. Okay. Now in this lecture, what we have learned till now is your inventory turnover ratio. And the second we have learned on return on asset. No, not return on asset, your asset turnover ratio. It's here. And at last we have learned the EV by EBITDA model. So it's here. Okay. So these are all your ratios, and once you click on save columns, you will get all of them in a single table. And this is like the real-time data. So you can just analyze them. How are they varying as compared to their peers, and how are they varying as compared to their medians. If you find any abnormality, or for some of the ratios like profit ratios, you can even go to moneycontrol.com and analyze how is the historical performance. So that's all for the financial ratios. And yeah, I mean, we have finally completed this table. It might be looking easier now if you have proceeded it from part by part. But if you directly jump to this lecture, they might be looking a lot of ratios and you might be confused. So we would recommend you to start from lecture 5, 6, 7, so that you can cover financial ratio part 1, 2, 3 before coming to the financial ratio part 4. Now I'm pretty sure you might be surprised that just with the mathematical ratios, you are able to achieve so much. I mean, let's look at this column second. So you are able to account whether price is cheaper or not by looking at PB ratio. You are able to see if the shares are earning well or not by looking at the EPS. Then you can compare if the stock is overvalued or undervalued based on the PE ratio. What is the growth rate based on the PEG ratio? You can find out the debt situation of the company using these three ratios. You can find the interest possibility that the company can pay off its interest or not using interest coverage ratio. Then you can check the profit margins using these three ratios. And you can check from the respect of the company, what is the return on capital employed, and also from the shareholders' perspective, how much returns are they getting over the share price in 1 or 5 years. And at last you are able to get what is the inventory situation. I mean, you are literally able to peek inside the inventory without going anywhere through this ratio. I mean, it's wonderful. You are able to achieve so many things, so many data points, so many conclusions just on a single table. And trust me, I mean, years before, this might be a task for a week or maybe a month to populate a table like this. And you have it within, I think, 2 or 3 minutes. So yeah, use it well, and always try to understand the physical significance of all the columns before just jumping and making conclusions. that's all for lecture 8. We have finally finished financial ratios with this lecture, and we have broken down financial ratios into 4 of the lecture 5, 6, 7, 8. Please feel free to check them out. Also feel free to provide any suggestions, feedbacks on the above given email ID. And thank you for joining. We hope you learned something today, and see you again in the next lecture.